We now have got prominent economists that are warning of the sort of 1976 style IMF bailout if we don't change the fiscal decision making in the country. So what I'm trying to understand is European economies do have high public debts, but our debt is particularly high. We are an outlier when we compare us against the European countries. And I believe that part of it is because the interest rate that we pay on the public debt, the bigger percentage of it is linked to inflation. It's actually like indexed for the inflation. Now, from the investor's point of view, and the big mutual funds and things like that, like that's a great deal. But why is what's the trade-off for the government to have that? Because currently it doesn't seem to be working particularly well.
No, nice bit of understatement in your closing there. Doesn't seem to be so. Index-linked stocks, gilt stocks, currently ours is about 24.5% of the debt is index linked. Just looking at the figures now, Italy's is the next one down. In the G7 is Italy at 11.7, and it goes all the way down to Japan at 1%. The reason that we have so many goes back to the 1970s, when UK was sort of unique in having fairly persistent double-digit inflation, and it made us quite a poor, prospect for investors. So trying to raise money on the capital markets was probably, well, it wasn't probably, it was definitely difficult. So what the Geoffrey Howe as Chancellor did in 1981 was introduce these index-linked instruments. What that was intended to do was to deliver confidence to investors that their investment was safe in the UK, and that that kind of worked over time. When we did, we were able to get inflation under control and all of this kind of stuff, and it kind of worked over time, to the extent that actually it was calculated that over the course of, I think it was from 1981 to 2023, the government actually saved money as a result of this measure by about 100 and something billion. The second reason was because the pension funds at the time had lots of index-linked liabilities through defined benefit pensions, which are sort of very generous final salary schemes that used to exist in the private sector when life expectancy was lower, and this kind of thing. So there were lots of index-linked liabilities. So the government was sending a confidence message to pension funds as well. And it worked. Britain did become a bit of a safe haven for investment and these kinds of things. However, we're not in that world anymore, and those chickens are very much coming home to roost. And we're now starting to see that our debt interest spending is starting to go through the roof.
I think it's enormous.
I think it's well over 100 billion now. It's our fourth highest item of government spending, and it's forecast to be 132 billion, I believe, by 2030. We also live in a much more, uncertain world. So inflation shocks, and we've got sort of inflation slightly more bedded into our economy than others at the moment. And, we don't produce much of our own energy anymore, for instance. We're reliant on global energy markets. And when there's global external shocks, we're sort of at the whim of global energy markets. Supply chains are much less certain than they used to be, for instance. That can help drive up inflation. So we're sort of in a position that's not particularly fit for a much more uncertain world that we seem to be heading into. I think everybody can see that. But that's the reason that we have such high index-linked gilt stocks. So it was originally a good idea until it was a bad idea.
I mean, yeah, it's been like 50 years now. So why did the government not renegotiate the terms once the UK sort of stopped being this, investment sort of playground, if you know what I mean,
Yeah, yeah,
because
yeah.
you would think that before this sort of the quantitative easing and all of the sort of essentially printing money that we did in the last 5 years, someone would have think, hold on a minute. Like,
Yeah,
was there
yeah.
just not enough time, or like, why did they not renegotiate it like in early 2000s?
Yeah, in fact, the opposite happened. Gordon Brown and George Osborne, as chancellors, both put the foot on the accelerator with these instruments, actually. And it wasn't until Philip Hammond was chancellor, and in around 2018, they were looking at this, and they basically started to cut back on it. By that time, is it too late? Obviously, it kind of is, but there was an acceptance at government level that this actually um, this wasn't a good longer term bet, even or even longer term than the early 1980s. So there was an acceptance in government that it wasn't going quite in the direction we hoped. Even in the mid 2000s, or was it in the 2010s? The House of Lords Economic Affairs Committee issued a report, sort of sounding the alarm on this, but times were good. Inflation was low, interest rates were 0.1%, etc., etc. So it's much easier to stick your fingers in your ears and just look at people um, who focus on the basics. Money costs money, etc., etc. And just,
Mm-hmm.
well, you guys are cranks. The world's changed now, and there's low interest rates, and we've worked out how to navigate global markets in these ways until it all comes crashing down like it has now, and debt interest costs are just going through the roof, and will only continue to go one way, unfortunately.
If you enjoy this clip and you would like to support the show, all you have to do is press subscribe. And to watch the full conversation, you can go right here. I'll see you there.